stemming from commercial and residential real estate sectors and from global geopolitical conflicts and technological developments. When two regional banks failed last March, we acted quickly to prevent contagion to banks with similar vulnerabilities and to maintain confidence in the banking system. The Council also increased transparency this year, issuing an analytic framework that for the first time provides the public with in-depth information on how it monitors, assesses, and responds to potential financial risks. Let me now highlight 5 areas of ongoing work that are further detailed in the Council's 2023 annual report. First, the Council is focused on risks from the banking sector and from non-bank financial institutions. It supports member agencies' plans to review whether capital measures appropriately reflect a banking institution's ability to absorb losses, improve resolvability at large, complex, or interconnected banks, and address vulnerabilities from uninsured deposit levels and depositor composition. Non-bank financial institutions are an important source of capital in financial markets, but also pose potential risks to the financial system, including risks related to liquidity mismatch and leverage. Securities and Exchange Commission initiatives focused on hedge funds, money market funds, and other investment funds are an important step forward here. Second, the Council is focused on member agencies enhancing financial stability risks from increasingly severe and frequent climate-related events. Financial regulators should also continue to promote disclosures that allow investors and financial institutions to consider these risks in their investment and lending decisions. Third, a key focus has been bolstering protections against cybersecurity risks. The Council promotes sharing timely and actionable cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiencies, and potential risks like cyber and model risk. Financial institutions, regulators, and market participants should continue deepening their expertise and monitoring capacity in this area. Fifth, the Council is focused on digital assets and related risks, such as from runs on crypto asset platforms and stablecoins, potential vulnerabilities from crypto asset price volatility, and the proliferation of platforms acting outside of or out of compliance with applicable laws and regulations. Applicable rules and regulations should be enforced, and Congress should pass legislation to provide for the regulation of stablecoins and of the spot market for crypto assets that are not securities. We look forward to continuing to engage with Congress on this. With this overview, I look forward to taking your questions on these and other areas.
Thank you, Secretary Yellen. I'll recognize myself for 5 minutes. And so let's begin with your last point on the regulation of the spot market for digital assets. This committee has produced 2 bipartisan bills, one on stablecoins, one on market structure to regulate the spot market of digital assets and provide this clarity between the CFTC and the SEC. So you testified that FSOC's view is that we need federal law and law changes on the spot market. Can you tell us why? Can you describe why? That's FSOC's belief.
Well, there are many areas with respect to digital assets where we do have clear regulatory authority, but we've identified some gaps where for consumer investor protection and to address financial stability risk, it would be very useful for Congress to take action to fill those gaps. And the CFTC, for example, doesn't have supervisory or regulatory authority with respect to spot markets in commodities like Bitcoin. So that's a regulatory gap. Furthermore, stable coins pose risk to the financial system that both FSOC and the President's Working Group on Financial Markets have identified as potentially becoming significant over time. And we would very much welcome an effort by Congress to create a regulatory framework that would be appropriate to address those risks.
So similar to, so stable coins are now being regulated by the states. New York has a very resilient regime. Are you suggesting something like the New York regime would be applicable to fix this problem?
Well, FSOC believes that it's critical for there to be a federal regulatory floor that would apply to all states, and that a federal regulator should have the ability to decide if a stablecoin issuer should be barred from issuing such an asset. Also, we believe that because wallets are a critical part of the stablecoin ecosystem, and we've seen many instances in which there have been significant losses, that it's critical to enact regulatory protections for holders of wallets.
So back to the spot market, though, as in your report, you state clearly that we need to change law for us to have proper regulation of the digital asset spot market. Is that correct?
Yes, that's a recommendation.
Okay, so broader. Let's go to the broader set, not the emerging issues. But in November, FSOC issued its final guidance on non-bank designation. Are there firms that FSOC has identified that are being analyzed right now for designation?
Well, I don't think it's appropriate for me to talk about individual firms. We've certainly not reached a stage at which the council has taken any action or received recommendations with respect to designation. We did put out, as you know, you mentioned, revised guidance pertaining to non-bank designations, and we published an analytic framework. But we wanted to make sure that our entire toolkit that Congress gave to FSOC is usable. There are many tools in that toolkit, and the analytic framework recognizes that designation is only one of those tools. It's not in any sense the preferred tool. It really depends on the specifics of the financial stability risk.
What many of us have highlighted is the fact that that is such an opaque process that it leads to greater instability, greater uncertainty in the marketplace. But let me finish with this: the overall economy. As Fed Chair Powell was interviewed this past weekend on 60 Minutes, and he says that the American people, they have a right to be unhappy. The cost of food is dramatically up under your tenure as Treasury Secretary in this administration. What do you say to the American people that are unhappy with paying more for the basics of life?
Households have been struggling through the pandemic with many burdens, including a higher cost of food and some increase in gas prices. We've had a couple of years of high inflation, and it's a top priority of this administration to bring inflation down and to use the tools we have to reduce the burdens on hardworking households. We have certainly used it with respect to healthcare costs, limiting insurance premiums for healthcare, the co-pays for insulin.
My time has expired. Thank you for your testimony. I yield to the ranking member, Ms. Waters.
Thank you again, Mr. Chairman. Secretary Yellen, I again want to applaud your excellent work and that of the Federal Reserve and FDIC to quickly act last spring to contain the damage from the sudden failures of Silicon Valley Bank in my state, Signature Bank, and First Republic Bank that could have spiraled out of control into a costly financial crisis, a recession, and corresponding layoffs, foreclosures, and lost savings for millions of people. Of course, some of us warned about Trump's deregulation efforts in S-2155, a Republican bill that Trump's regulators used to reduce capital and other requirements for regional banks like SVB. In fact, it allowed Silicon Valley Bank to opt out of maintaining nearly 2% more capital for their book of securities that had a large amount of unrealized losses when the federal government raised interest rates. When SVB was forced to sell those securities at a steep loss, it alarmed customers, resulting in the fastest bank run in the United States history. Since then, Republicans have tried to claim that capital had nothing to do with the bank failures, but their own witness, Margaret Tyree from Davis Polk, testified that SVB's capital shortcoming was a problem and she supported efforts to fix it. I'm so happy our federal banking regulators have issued proposals to fix this issue and otherwise strengthen capital requirements for the largest banks. The Financial Stability Oversight Council urged regulators to finalize these bank capital rules in its annual report. Would you briefly try and explain to members why the bank capital proposal is so important for financial stability?
Well, it's really critically important to the safety and stability of our entire financial system for there to be strong standards of capital liquidity and risk management for banks, especially for the largest banks. And the banking regulators have proposed new rules to address these risks and to implement an international agreement on Basel III. I would say that the proposals are out for comment, and it's really up to the banking regulators to decide on the appropriate specifics.
Thank you, Madam Secretary. Unfortunately, I want you to know that the mega banks are working overtime to try and kill the bank capital proposal, claiming, among other things, that it will limit their ability to make loans to communities of color that they already rarely serve and routinely have discriminated against over the years. But capital is not something that's locked away, but rather it is a source of funds that banks can redeploy. In fact, research shows that better capitalized banks actually lend more, not less, to consumers in both good times and bad. Secretary Yellen, will lending come to a halt if regulators implement their capital proposal? Did you hear similar industry attacks when you were at the Fed helping implement the Dodd-Frank post-crisis reforms?
Well, I think what we found during that time was implementing strong capital liquidity and risk management rules led to a stronger banking system that was better able to meet the needs of borrowers throughout the country. And I think we saw the benefit of that when the pandemic struck. And the bank, well, there were many financial stability risks that did materialize, the banking system was strong and able to meet the credit needs of the country's businesses and households.
Secretary Yellen, do you recall the weekend that all of the regulators and so many people were involved in after the failure of Silicon Valley Bank to try and save this country from experiencing a bank run that could have actually crippled our banking system? Do you recall the work that went into that? 24 hours a day for 3 days, so that when we woke up on Monday morning, we were safe, rather than we were going to get back to what happened back in 2008. You remember that?
I will never forget it. I was involved in it, and we did everything we could to put together a package of measures that would stop what could have become a run on the banking system, to the huge detriment of our economy and to hardworking Americans and businesses.
And again, if there had been adequate capital at Silicon Valley Bank, we could have avoided what took place in the way that it did.
Well, there was an issue with their management of interest rate risk, which had produced mark-to-market losses on long duration assets that they held. And that was coupled with very heavy reliance on uninsured deposits that were concentrated among a group of tech firms that were active on social media. We saw a run that was the largest and fastest of anything anyone has ever witnessed in this country.
Thank you very much. You support
Gentleman,
2% increase in capital for all of the biggest banks.
I'm going to let the banking regulators decide what the
gentlelady's
right
time.
thing
Thank you.
is.
Thank you.
We'll
Yield
now go
back.
to the Vice Chair, Mr. Hill, for 5 minutes.
Thank you, Chairman, Madam Secretary. It's nice to have you back in the committee. We're grateful to have your expertise. Last time we were together, we talked about the subject that Chairman McHenry brought up, which is FSOC's recommendations on stable coins and the spot market. And I was very pleased to hear your testimony on that, reiterating that Congress does need to take action there. And I'm proud to have worked with the chairman and my Democratic colleagues on bipartisan bills to do precisely that. With that said, Madam Secretary, as chair of FSOC, what have you done to encourage the SEC and the CFTC to work together in these areas to make these bills stronger and, cooperate together to make our work here in Congress go more smoothly? Have you had a meeting with the chairman of the SEC about stable coins and the digital assets regulatory framework?
Well, the President's Working Group on Financial Markets produced a report.
Yes, ma'am. We've read that report thoroughly. I'm talking about in recent months, since June and July last year, for example, when we marked up this bill in July. Have you worked with Chairman Benham or Chairman Gensler on this legislation? Have you talked to them about it?
I mean, I've talked to them often over the last couple of years about stable coins. And I'm not sure if I've talked with them over the last couple of months on this topic, but we've had many conversations.
Another area that I think Chairman Gensler has stumbled in is his proposal on custody, which the bank regulators like the Comptroller of the Currency and the Federal Reserve don't support. Many of us on this committee are concerned about that. Do you support the SEC's rule on custody as proposed?
We have had some concerns about how it would impact banks, and that's something I have discussed with the chairman.
Thank you, Madam Secretary. Let me turn to the CFPB Director Chopra suggesting that FSOC use for the first time ever Title VIII authority to address payment clearing and settlement activities. For example, he's proposed considering designating certain non-bank payment platforms as systemically important. Do you support that?
We've not taken a position on that. What I've said is that I think it's important for Congress to address this issue. We've made recommendations, and we think that is by far the preferred approach. And I've not looked into other alternatives. We stand ready to work on a bipartisan basis with you to take this on.
Thank you. Well, for example, would you agree with the director that peer-to-peer payment activity or non-bank peer-to-peer payments represent financial stability risks to the financial system overall? Zelle, Venmo, you think peer-to-peer payment systems present a financial stability risk to the system?
I don't believe that's something that FSOC is highlighted, and I
think the issue, I want you to reflect on that. I'd be happy to have your views in writing on that. But I think some FSOC members may not be viewing the designation of a non-bank activity as really a last resort, that we have regulatory systems and other rules to handle that. And I think this is a particular case. For example, do you think the Fed, having been the chair there, has sufficient expertise, knowledge, and supervisory authority to deal with companies in different industries, like asset managers or cloud providers or big tech companies, if they were to be designated under that sort of an idea?
I do want to make clear that there's nothing about FSOC's approach that places designation as a preferred approach. There are many tools and only certain situations in which it would be appropriate. Congress designated in Dodd-Frank that if a company whose material distress poses severe threats to financial stability, the Fed should be the regulator. And I certainly remember from my time there when several insurance companies had been designated that the Fed built substantial expertise to
Thank you, Madam Secretary.
carry that out.
Gentleman yields back. We'll now go to the gentleman from California, Mr. Sherman, for 5 minutes.
You play an important role on foreign policy. I hope in dealing with the IMF, you make it clear that our support for Pakistan's request is focused on the fairness of their elections and human rights and democracy in Pakistan in general. I hope you'll do everything possible to make sure that any change at the IMF does not give Iran additional special drawing rights or allow them to use their existing special drawing rights to turn into currency that they can use. And finally, I hope that we see sanctions against the individuals Human Rights Watch has identified with the Amhara regional forces in northern Ethiopia, and that you'll focus on Eritrea's terrorizing of the Tigray region of Ethiopia. On taxation, I want to commend you on the direct file program, but you can go a step further. Senator Warren and I have focused on the 36 countries where they send you a pre-populated return. And you can just click yes, or you can change it. And of course, it's voluntary. You don't have to look at it at all. And I look forward to the day when the vast majority of taxpayers can just click yes, or maybe add the name of a newborn child and be done with their tax return. On crypto, you were instructed by the Infrastructure Investment and Jobs Act to have the rules enforced for the 2023 tax season. They're not enforced. So you're behind on rules designed to enforce taxation on crypto transactions. But I want to focus your attention on the capital gains allowance. We provide at very great cost to our Treasury an incentive for investors to invest in stocks, chiefly, also real estate, because we want to build our economy. And there's arguments as to whether it's effective, whether it's very effective or only slightly effective. But the reason for capital gains allowance is to encourage investment that builds an economy. Can you think of a reason why we would, at our cost of the U.S. government, incentivize people to invest in the Chinese economy? Why do we provide a capital gains allowance for investing in Chinese stock? Is there any reason you can think of?
Well, in general, we've made a decision that capital gains should be treated similarly and only taxed when they're realized.
Well, I'm
And-
not talking about realization. You sell a Chinese stock at a profit. You pay a lower tax on that than your assistant pays on his or her earned income. Now, that's to encourage you to invest in the stock. Why do we want to, is there a national purpose in encouraging Americans to invest in Chinese equities that you're aware of? Because I'm not.
Well, I mean, in general, I think the view has been that both inward and outward investment are economically beneficial. There certainly
I'll want to
can be
move on to
cases-
another issue,
there
but
can be cases
encouraging the building of the Chinese economy is not thought by most members of Congress to be a good use of federal funds. On bank regulation, there's no easy answer. If our standards are too low, we could see the need for bailouts as we did in 2008, which not only shakes the economy, it shakes the social fabric of our society. But if those standards are too high, we lose economic growth and we move money away from banks, which do an inadequate job of lending to small businesses in our districts, over to Wall Street, where they don't even, for the most part, pretend to do the job of investing in small businesses in our districts. We have the possible designation of SIFIs. When I was here and we crafted that definition, the thinking was some companies have such liabilities that if they go bankrupt, it destroys the whole economy. Is there a reason why you're focused on identifying as SIFIs entities that don't have substantial liabilities, such as mutual funds and money managers?
I'm sorry, is that we're certainly focused on the entire financial system. FSOC is not only on banks.
Right, but is your why would you designate an entity that doesn't have substantial liabilities?
We would only designate an entity if FSOC determined that its material distress would pose a severe threat to the financial stability of the United States.
Thank you very much.
The gentleman from Oklahoma, Mr. Lucas, is recognized.
Thank you, Mr. Chairman. And Secretary Yellen, thank you for testifying today. During our discussion when you were here last before the committee, the Basel Endgame proposal had not been officially proposed by the banking regulators. And since then, over the past 6 months, there's been a robust response to the overwhelming negative consequences of the proposal. I'm concerned that the Basel Endgame will undermine many of the steps taken by Congress to strengthen the financial system and support the economy. One example I have focused on is the impact on derivative end users. Back in 2010, I sat on the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, like farmers, ranchers, small businesses. This has a long history of broad bipartisan support. Unfortunately, both of the proposals from the Federal Reserve will drive up the cost of hedging for end users and undermine the long-standing work done by Congress and this committee. And this is just one example of how the Fed's proposal moves us in the wrong direction. Secretary Yellen, at some point in the months ahead, the banking regulators will vote on a final rule. When we last discussed Basel Endgame, you said that Treasury would have the opportunity to provide feedback on this proposal. Given Treasury's mission, which is to maintain a strong economy and promote economic growth, has Treasury provided feedback to the Fed, number one? And number two, are you confident that the proposal will not undermine the resilience of the U.S. capital markets that are so critical to the economy?
So I'm not aware that Treasury has provided any formal feedback to the Fed on the Basel regulations. As you know, they've received many comments expressing concern about a number of different proposals that were embodied in the Basel III package And I know that all of the banking agencies that publish that are considering how to respond to those comments and concerns in trying to craft a final rule.
Well, are you concerned that the proposal will undermine the resilience of the U.S. capital markets?
I'm not going to take a position on the details of the rule. I would just say again that I believe that there should be strong capital and liquidity standards to ensure that these institutions operate in a safe and sound manner. But it's up to the banking agencies to evaluate the specifics.
So it's fair to say that whatever concerns might be at Treasury don't rise to the point of providing feedback, okay? Another aspect of the Basel Endgame is the impact on the U.S. Treasury market. Consumers, businesses, governments, the global financial system depend on a well-functioning U.S. Treasury market. And of course, a healthy market for U.S. Treasuries is essential for U.S. government operations. However, the proposal from the Fed could cause banks to pull back from the market-making activities in the Treasury's future markets, which would raise costs for market participants. At the same time, just this past December, the SEC, the Securities Exchange Commission, finalized a rule that would increase central clearing for Treasury markets along with other reforms. So you have the increased cost coming from the Federal Reserve, you have the significant market structure reforms coming from the Securities and Exchange Commission, all impacting U.S. Treasury market at the same time. I just worry that this could create a huge problem. So, Secretary Yellen, how have you engaged the SEC and the Fed to evaluate the cumulative impact of the proposals, and how can we be sure that there will be no significant market disruptions? Turbulence may be about a better word for it.
Well, we've formed an interagency working group that includes all of those agencies and Treasury and the New York Fed to focus on the resilience and operation of the Treasury market. It's critically important to us that the Treasury market is well-functioning, deep, liquid, and can enable the dollar to be the most secure asset of any in the world. And they are looking at specifics, including improved disclosure. They have taken the view that increased central clearing can make the Treasury market more resilient, and they're considering many factors.
The gentleman's time has
Chairman,
expired.
my time has expired, but not my concerns.
Thank you. The gentleman from Georgia, Mr. Scott, is recognized.
Secretary Yellen, in its 2023 annual report, FSOC identified several market vulnerabilities related to commercial real estate lending. FSOC specifically identified significant concentrations in the commercial real estate for many of our regional and community banks as a risk to our entire banking system, which means our entire economy. And I want to ask you your thoughts on that. And you went a little bit further in that report, and I quote, "The vulnerabilities to the regional and community banks are negative trends in the office market and an erosion in high multifamily property values." Now, Chair Yellen, we're talking about the backbone. These communities and regional banks are the backbone of our banking system for most of the American people. So My question to you is, given that the commercial real estate loans are the largest loan category for half of U.S. banks, and that 1/4 have commercial real estate loan portfolios that are significantly larger relative to their capital reserves, Secretary Yellen, should we not be concerned that a spillover effect could lead to banks lending less to other very important sectors of the economy, like our American people?
Well, thank you for that question. Commercial real estate is an area that FSOC focused on in its annual report. And it's something that the Financial Stability Oversight Council addresses in its meetings on a regular basis. Because as you mentioned, many, especially smaller and regional banks, have concentrations of commercial real estate lending. I think office properties in some cities are of special concern because vacancy rates have increased and there have been declines in property value.
Yes, and my time is slipping by, but I've got to ask your opinion on something that is very, very important to me, and that is the implementation of this Basel III endgame proposal. As you know, the largest banks would be required to hold more capital for their actual risk taking, and I remain deeply concerned that this will further diminish the credit capacities and weaken the economic conditions of our American people. Tell me your thoughts on this Basel endgame business.
So the banking agencies, I know, have received many comments that have expressed this concern. And the heads of those agencies, the financial regulators, have expressed a commitment.
But I want to know, I have such respect for you and your economic genius and prowess in the financial system. And I think the majority of our committee is very much against this. How do you feel about it? Are you with us on this? This will be terrible for our economy.
Well, I think it's important to ensure that credit availability is not significantly diminished.
But do you support this endgame business with Basel?
I said, I do believe it's important to have a strong banking system with adequate
I
and
really wanted a
sensitive
yes or no.
capital.
The gentleman's time has expired. The gentleman from Texas, Mr. Sessions, is now recognized.
Mr. Chairman, thank you very much. Madam Secretary, welcome back. You're here today to discuss this annual report of 2023 from FSOC. And I want to refer to, if you have someone there giving you notes, page 10 of the report. But I'd like to start with, on February 16th, 2022, then the chairman of the Budget Committee, John Yarmouth, said in a well-understood statement, quote, "Congress need not worry about rising borrowing costs because we can print all the money we need," end of quote. The national debt at that time was 30 trillion. It is now 34 trillion, and the national debt will triple, just the projection, from 475 billion in 2022 to 1.4 trillion in 2032. At what point does this become a problem? And I say this because your own report says on page 10 Higher interest rates and slowing economic growth, they correspond to each other, have increased non-financial corporate credit risk. If credit quality significantly worsens, a potential wave of debt defaults could lead us to large redemptions at investment funds with significant liquidity mismatches and in turn disrupt bond market functions. Moreover, such defaults may have a cascading effect across broader financial markets. Madam Secretary, tell me about what Chairman John Yarmuth, a Democrat from Kentucky, said, and tell me your viewpoint.
Well, let me make sure. Your question was about the federal debt, was it not?
Well, of course it is. That's what John Yarmuth was
Yeah.
talking about, Chairman of the Budget Committee.
Well, I think it's critically important that the U.S. Be on a fiscally sustainable path. And President Biden has put forward a series of budget proposals, most
Spending
recently,
proposals.
no, and also tax proposals and investment proposals that would, I believe, guarantee that we are on a fiscally sustainable path.
Does that mean ever attempting to balance any one particular year over the next 50 years?
Well, I don't think the budget needs to be balanced to be
This
on a
is what I wanted to
fiscally.
get at. So
resti-
your tendency is to say, as Mr. Yarmuth did, Congress need not worry about rising borrowing costs. As you know, Treasury and the Fed are going to have to go to the marketplace and pay an extra large amount of money because of the risk that our debt now poses to the United States. And so they are paying record amounts for Treasury, which takes money that is in banks, local banks, out of local banks that provide small business loans, housing loans, that provide agricultural loans, that do all these things. It's shifting the marketplace literally $10 trillion from where it had been in stability to now to the Fed.
I believe that.
And we're paying for that.
I agree with you that we need to be on a fiscally sustainable path. And it's critical to reduce deficits in order to ensure that that's the case. And that is why President Biden's budget for 2024 proposed an additional $2.5 trillion of deficit reduction, coupled with investments in our economy that are critical to ensure that we grow and collect tax
Madam-
revenues that are.
Thank you, Madam Secretary. I would tell you that putting 10 million new illegal people in this country and living in Central Texas, seeing the federal government let all these people in, give them free ticket rides, cell phones, go to the city of their choice, live in housing to knock children out of their own school, protect them at Chicago International Airport, doing all these things is not wise management of our resources. Mr. Chairman, and Madam Chairman, I want to thank you for being here. Mr. Chairman, I yield back my time.
I thank the gentleman, and the gentlewoman now from New York, Ms. Velasquez, is recognized.
Thank you, Mr. Chairman. Ms. Secretary Yellen, welcome to the committee and thank you for being here. I just want to say that I have great respect for my friend and colleague, Mr. Scott, but he does not speak for all members on this side of the aisle on the Basel III proposal. I, for one, support stronger capital requirements at our largest institution, and I want the record to reflect that. Ms. Yellen, the FSOC's annual report identifies property insurance, which is becoming prohibitively expensive or inaccessible for homeowners and developers, as an increasing risk to financial stability. This is becoming a more pervasive issue in my community, particularly when it comes to affordable housing. How is FIO working with the NAIC insurance carriers and state regulators to analyze this increasingly important issue?
Thank you for that question. We're very focused on rising insurance costs in particular areas of the country and the risks that it poses to homeowners, to banks, to financial stability. FIO has been working to improve our understanding of the ways in which climate change is impacting the availability and cost of insurance coverage. And in early January, OMB approved a data collection effort by FIO that would be at the zip code level to collect granular data to evaluate what's happening to insurance premiums and availability across the country. FIO looks to work with the NAC that's engaging in a similar effort to reduce the burden associated with this data collection, and that collaboration is ongoing.
And how is FIO working to ensure that it is not duplicating efforts already conducted by the NAIC or state regulators?
So there is a collaboration. The focus is and need for data is slightly different for NAC and FIO, but I think there's a good chance that they will be able to collaborate and go out with a single collection in order to collaborate and reduce burdens on insurance companies.
And has the council or FIO had any conversations with HUD on how these insurance premiums are impacting the operation of its affordable housing programs?
I believe that FIO and the council have had discussions. I know they have had discussions with other agencies. I'm not positive. I assume HUD would be in them, but I'd have to verify that.
Well, I will encourage your department to really talk to HUD, because we cannot address the affordability crisis that we have in housing in this nation without tackling the issue of the cost of insurance in our country.
Absolutely.
Last February, the Treasury Department published a white paper that identifies several challenges in the financial services sector's growing reliance on third-party cloud service providers. In response, an executive steering committee was launched by the FSOC. How has the executive steering committee worked with the big three service providers and the member agencies to reduce identified challenges?
So the executive steering group has been very active on this issue. They have formed, I believe, 9 different public-private work streams. Each one is looking at a specific gap that was identified in the report that was issued last February. And they're trying to understand also what authorities the existing regulatory agencies have, how they have been using them, and they will release recommendations later this year.
Thank you. I yield.
The gentlelady's time has expired. The gentleman from Missouri, Mr. Luke DeMeyer, who's also the chairman of the Subcommittee on National Security, is now recognized.
Thank you, Mr. Chairman. Welcome, Secretary Yellen. Good to see you today. As Vice Chairman of the Small Business Committee, it's disappointing that you still, almost 3 years from your statutory requirement to show up in the SBA hearing and get a report on PPP, have not done that. It's kind of amazing. You and your administration continue to pick and choose which laws you want to obey, which ones you want to ignore. So very disappointed. First question, though, deals with the World Bank. I had a conversation last week with the president of the World Bank, and he was talking about the need to increase capital. Unfortunately, that same board continues to give China preferential treatment and allows the world's second largest economy to be considered a developing nation. My question to you is, will you commit to making a capital increase conditional on graduating China for World Bank assistance and not allowing Beijing's voting power increasing the voting power at the institution?
So let me first say, we're not looking for a capital increase at this time for the World Bank. We do
I'm not
believe,
saying you did. I'm saying that the president of the World Bank, if that gentleman with the camera would get out of the way, please. Thank you. If, you know, they're looking to do that. So my comment is, let's don't do that unless you can get China, who wants to also increase their share, in a corner and not allow them to continue to be a country that gets assistance from the World Bank when they've got the second largest economy in the world, and then allow them to increase their voting.
well, let me say we are strongly opposed to World Bank lending to China. We've pushed the World Bank and other MDBs to reduce and eliminate their lending volume to China.
Okay, well, my comment is, we gotta work harder. We gotta make sure they don't have access to that bank. It's very important. You made a comment a minute ago that I really appreciate from the standpoint of the concern I have with AI. It is a wonderful technology. Hopefully it can do wonderful things, but it can also be used for some bad stuff. As we saw with Silicon Valley, social media and the 24-hour news cycle, suddenly within 10 hours, had $42 billion run out of the bank as a result of a tweet, and social media following that around. AI could do the very same thing, and I'm concerned about that and have got some bills to address that. Haven't got a hearing on them yet, but hopefully that will happen soon. Along the lines, though, you talked about FSOC's role in these three banks and how you were able to help resolve the situation. My question to you is, what has FSOC done to fix the situation with these banks that are upside down with their interest rate? And their business models are off. They should be regulated differently. They should be forced to change how they're operating. Are you doing that?
Well, the responsibility for supervision of these banks and regulation rests with the banking agencies.
I agree with that, Madam Secretary. The problem is you, as the chairman, are overseeing the comptroller, also have the ability to go in and change these business models. Are you doing that with the national banks that you oversee?
Well, the OCC is an independent agency within Treasury. The FSOC is trying to understand and discusses the extent to which.
Madam Secretary, FSOC has got a tremendous amount of control over this. They can dictate how these things are done, how regulatory attitudes are towards situations. My question is, are you taking an active role in trying to get the banking models that are upside down and beyond the norm, are you getting them back in order?
I would say that this is a responsibility, the supervision of interest rate risk and liquidity risk is a responsibility of the banking agencies.
Well, I agree, but you oversee the banking agencies. So I'm hoping that you have some directions to those agencies to allow them.
We do not oversee the agencies. We identify risks and sometimes make recommendations to agencies about actions that they should take.
Well,
and they do have frameworks for managing liquidity, capital, and interest rate risk.
I got one more question to ask you here very quickly. Last week, Chairman McKinney, Mr. Jordan, Mr. Huizenga, and I sent a letter to FinCEN Director Gacke highlighting how FinCEN, an agency created to promote our national security, was using its authorities to target law-abiding citizens with countervailing political views. These allegations are evidences of Obama administration's Operation Choke Points, where I spent years investigating as the chair for the institution subcommittee. I'm just very concerned about that. We're going to have Chairman Gacke, our Director Gacke, in our committee very soon, and then we're going to ask her about her involvement with you and your response to that.
The gentleman's time has expired. The secretary is directed to respond to that question in writing if she could.
Yes, I will.
Thank you. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Madam Secretary, thank you for being here today. I want to follow up on my friend and colleague's question, Mr. Scott, earlier. I think he started out in this direction and then was running out of time and went in another direction. In my community, Kansas City, Missouri, there is a great deal of concern, and I would imagine around the whole country, that pandemic is not taking all of the lives that it was taking a couple of years ago, but its impact is still here, particularly on the economic level. We are probably all over the country concerned, or should be, I think, of that TREP company's analysis of commercial real estate. And they issued a frightening report, frightening is my adjective, that there is about a $448 billion worth of loans that matured last year, 270 billion of which were from banks. And we're having people breaking leases. We have others trying to renegotiate leases. In my estimation, we've got a problem with our commercial real estate, and it could impact, and I think that's where Mr. Scott was going, it could impact other components of the economy. Do you have a concern about where commercial real estate is and may continue to go?
Yes, I do have a concern about commercial real estate. We discuss it in the FSOC annual report, and FSOC has been quite focused on it. The banking supervisors have also been focused on commercial real estate and are working closely with the banks they supervise to discuss ways to manage and work with borrowers who have problems. They're, in some cases, working to make sure that loan loss reserves are built up to cover losses, that dividend policies are appropriate, that liquidity is adequate. So the higher interest rate environment, and in some cases, particularly the case of the pandemic, coupled with many commercial real estate loans coming due and needing to be refinanced in a context where vacancy rates in some cities are quite high, is going to put a lot of stress on the owners of these properties. And so the banking agencies are very focused in helping the banks manage through these situations.
So you're concerned but not distressed. Is that?
Yes, I mean, I'm concerned. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
Thank you. Madam Secretary, are you familiar with Larry Kudlow, the former director of the National Economic Council?
Sure.
3 days ago, he said that, well, he conceded that his prediction of a recession was wrong and admitted that the U.S. economy is doing much better than expected under President Joe Biden. And he said that on Fox News. He offered a mea culpa because he had, if you look at some of his comments previous to that, everything was horrible. Do you agree with Mr. Kudlow that the U.S. economy is headed in the right direction?
I absolutely believe it's headed in the right direction. Our growth is extremely strong. The labor market is at least as strong as it was prior to the pandemic. We've got, it's been 50 years since we've had a string of unemployment rates this long under 4%. And job creation remains utterly robust. more people are participating in the labor market.
Gentleman's
and
time has
inflation's on the
expired.
way down.
The gentleman's time has expired. The gentleman from Michigan, Mr. Heisinger, who's the chair of the membership, the Oversight and Investigation Subcommittee, is now recognized.
Thank you, Mr. Chair. And I'll just note to my friend from Missouri, when the government's throwing that much money into the economy, yes, it has been propped up. I will also note it's so strong that the Federal Reserve cannot lower interest rates with unexpected job growth in those areas. So we're seeing inflation continue. Madam Chair, I want to very briefly touch on this. You clearly are not, I think I wrote down a quote of yours, you're not going to take a position on the details of the rule. I'm talking about Basel III. Mr. Lucas responded, so any concerns don't rise to the level of feedback. Mr. Scott brought it up. A number of us have brought it up, both sides of the aisle. So who are you giving your thoughts to on the Basel III? Because clearly, I mean, with your background as Federal Reserve, FSOC, Treasury, you clearly must have thoughts about Basel III. You're not willing to share them with us, but who are you sharing those thoughts with?
Well, I meet on a regular basis with all of the heads of supervisory agencies, including OCC, FDIC.
Okay, and the president, I assume too? You're sharing that with the president? Your thoughts?
I haven't had a meeting with the president on this specific topic.
Okay, so then I'm left to assume that we are just then to be left in the dark till things get sorted out, correct?
Well, there's they've put out a notice of proposed rulemaking.
I know that,
They're
but you've had a
evaluating
number
many.
of people on both sides of the aisle asking your opinion, your learned, educated, experienced opinion about it, and you've refused to offer any of those insights to us. So I can't come to any conclusion other than you're sharing those insights with others, but you're not willing to share them with Congress, which is your choice. I think it's a bad choice, but that's your choice. I want to very quickly ask you down a path, and I'm trying to be equal opportunity questioner on this because I just asked Marcia Fudge this not that long ago. With the disaster at the FDIC under Marty Gruenberg's leadership and the culture, I'm sure you saw the article that all of us saw in November regarding the unacceptable behaviors that have been happening there. I'm concerned how it might impact their mission, and most importantly, how it would potentially spill over into the safety and soundness of our financial system. Following those revelations at the FDIC, did you take any steps at Treasury to make sure that Treasury isn't suffering from some of those same culture problems?
I mean, we regularly, we have a rigorous process for reporting and investigation
Okay.
of
Nothing new necessarily. And I'm not trying to be accusatory. I'm not saying that there is a culture problem under your leadership. I'm just curious if that prompted you to respond. And since obviously FDIC is part of FSOC as well, I mean, there's multiple times that you would have interacted.
I'm not aware of any such allegations at Treasury.
Okay. Yeah, I'm not either. That's not what I'm saying. I just wanted to be clear. I'm asking everybody whether they have, when they saw the culture problems at FDIC, did that prompt anybody to change behavior or double down on making sure that whistleblowers are protected and those kinds of things?
We certainly believe in whistleblower protections and having in place systems that guard against the kind of thing that's alleged.
All right, I'll accept the answer. So I've got a minute and a half here. I want to shift topics to the CFRAC. Committee was established almost a year and a half ago. That's climate-related financial risk committee under FSOC. It looks like, according to the website, they've met twice, March 7 of 2023 and July 18. Your report devotes a lot of time to the potential impacts of climate change. In fact, you say that's one of the things the council is focused on member agencies, enhancing assessment efforts and increasing coordination around climate-related financial stability risk. That's in your written testimony. Has there been a problem? Has there been a lack of cooperation or coordination?
No, I think CFRAC is.
So then why are you having to enhance those assessment efforts?
Well, all of the agencies are increasingly focused on understanding the risks relating to climate change.
Okay.
And it's appropriate for them to work together to exchange
All right.
information.
In my closing seconds here, are there any CFRAC meetings that have not been listed on the website?
Not to the best of my knowledge.
Okay, could you check on that and please get back to me?
Certainly.
And then I guess I'll finish with this. I'm sure you're aware the SEC has been working on their climate rule for 2 years. Do they consult or do they just jam the rest of FSOC like they've been jamming those who they are trying to regulate?
The gentleman's time has expired.
It's
As
the
the Secretary.
SEC's rule. I'm supportive of their requiring disclosure on
Any
this.
additional comments can be submitted for the record.
Thank you, Mr. Chairman.
Thank you. Thank you. The gentlewoman from Ohio, Ms. Beatty, is now recognized.
Thank you, Mr. Chairman and Ranking Member. Secretary Yellen, thank you so much for being here today testifying. And also, I want to take this moment to thank you for clearly outlining for us risk factors, but then identifying the 5 areas that you're working on with the risk factors, and for being very transparent about that. And also for the work that you do to keep our financial system safe and secure. I'd like to start with climate-related financial risk. The FSOC report identifies climate change as an emerging and rising threat to the United States financial stability. I too am concerned about this threat, especially considering the fact that low income and minority households are more likely to face greater climate risk. Can you explain why these communities are at greater risk and how failing to address climate risk can exacerbate certain disparities that are already at risk, such as like housing values and the costs associated with home ownership in some communities?
Well, I believe there's a large body of research that shows that low-income communities are more exposed to some of the physical impacts of climate change, and that they may be less able to afford protections, whether it's for their home or insurance that's necessary to guard against it. And so it is a severe risk to low-income communities.
Thank you. Let me turn now to FSOC's guidance on the designation of non-banks as systemically important. First of all, let me thank you for your leadership in issuing this guidance. As we see increasingly large roles that non-banks are playing in the financial system, it is clear that any strategy to protect financial stability must also cover non-banks. Nevertheless, there has been some concerns about due process for non-banks that are designated as systemically important. FSOC's guidance emphasizes that non-bank designation process will entail engagement with both the company and its current financial regulator, if it has one. Can you describe what other due process protections exist for the company? For example, the ability to request a hearing, meetings with FSOC staff, or the need for a 2/3 vote for destination and how annual FSOC's reevaluation.
Well, I think you just listed the protections. The company would be provided with a great deal of information from FSOC if it completed stage 1 and entered stage 2. It would have opportunity to provide any information that it thought was eligible, the right to a hearing, and as you said, designation requires a 2/3 vote, including the vote of the chairperson.
And lastly, when I was the chair of DE&I and you would come before the committee, I think it's important again for me to thank you. You always had some of the highest numbers, or you admitted what you were doing and working on it. I think I should be concerned now in light of all that's happening across this country, including in financial institutions. I'm concerned about the effect that DEI rollbacks at financial institutions will have on our financial stability and on access to financial services in low income or marginalized communities. And so I don't know if you have any comments, or are you concerned when we are still struggling in America to make it look like America?
Certainly, let me say, the Biden administration, at Treasury and other agencies I'm aware of, we have a robust and committed agenda to promote diversity in all of the work we do, not only in terms of our hiring, but in terms of all of the programs. For example, at Treasury, we have undertaken research that you're probably well aware of that shows that low-income individuals, African Americans, are disadvantaged by the way the earned income tax credit has been. So we are trying.
The gentlelady's
to
time has
root
expired.
out.
Thank you.
The gentlelady's time has
Thank
expired.
you,
The-
Secretary Yellen.
The gentlewoman from Missouri, Ms. Wagner, is also the chair of the Subcommittee on Capital Markets, is now recognized.
I thank you, Mr. Chairman. Secretary Yellen, as Treasury Secretary, you championed requirements that any deposit flows into Americans' bank accounts totaling as little as $600 are to be reported to the IRS. Increasingly, we are hearing the federal government is suggesting banks search private financial transactions using highly partisan political terms, or check to see if customers made purchases that could be associated with legal sales of like firearms or even religious texts. My question is this: has Treasury, including FinCEN or federal banking agencies like the Fed, FDIC, OCC, instructed financial institutions to search Americans' legal transactions in attempts to surveil their purchases?
Well, we received a letter from you, I believe, on this topic, and we intend to investigate fully and to respond.
Have you
as soon-
instructed banks and
Have we-
financial institutions to provide this information?
Well, FinCEN's job is to work with financial institutions to make sure.
Are they instructing,
they-
ma'am, financial institutions to search Americans' legal transactions in attempts to surveil their purchases?
I promise a thorough look into everything.
Well, this is
that's
really
occurred.
concerning, and I would hope
I'm
that you
so-
get to it just as quickly as possible, Madam Secretary. Secretary Yellen, I'm going to give this a shot too, since we all have, on both sides of the aisle. The Financial Stability Oversight Council, of which you chair, Madam Secretary, you chair
I'm
FSOC.
aware of that.
In 2023, FSOC put out their annual report plainly stating that, and I quote, "The U.S. banking system remains resilient overall." And, I quote, "U.S. banks continue to have sound levels of regulatory capital." Do you still stand by these statements, ma'am?
As an overall statement, I do.
Then what is the need for the proposed massive increases in regulatory capital requirements from the Fed, FDIC, and OCC?
They have proposed regulations to enhance the safety and soundness of some.
But you just said that the safety and sound is there. It's resilient. They are well capitalized. It's clear in your, as a chair, your report.
Well, there are risks that that their guidance suggests could be handled better than it
All right,
has
let me
been.
move on. Secretary Yellen, in a 2019 letter to Secretary Mnuchin and in 2021 testimony to the Senate Banking Committee, you said that activities-based regulation is the appropriate approach for asset management. Given the FSOC's recent guidance regarding the designation of non-bank financial institutions as systemically important, do you still stand by those public statements?
Well, I'm not sure that I said such a sweeping statement as you read. I don't know.
I have it
I
right
don't-
here.
I
It's a
don't
letter.
know if
I'd
that's.
like it into the record, please. This is your letter with those words, ma'am. So I would tell you to go back to your 2019 letter and then again to your Senate banking testimony in 2021.
2019, did you say?
In 2019, a letter to Secretary Mnuchin, and in 2021, your testimony to Senate Banking Committee. You said activities-based regulation is the appropriate approach for asset management. I want to know why we're finding FSOC is saying designation bank financial institutions are systemically important. Clearly, others don't. Why do you believe FSOC did wrong that led to the courts vacating the MetLife designation in 2016, ma'am?
Look, there is no preferred approach to how to handle a financial stability risk that's been identified. In some cases, and perhaps this is what I was referring to, if that's an accurate quote,
It is.
we are, for example, concerned about risks associated with money market funds.
Are you doing
We
a
have
cost-benefit
been
analysis?
concerned-
Anything?
Excuse me, we have been concerned about the pressures on open-end bond funds that can be forced to sell less liquid assets. These are industry-wide practices that are
The
probably
court has already
best
vacated you once,
addressed
ma'am.
with activity-based approach.
Mr. Chairman, I yield
Secretary
back.
Yes,
The
he's-
Secretary may respond in writing the remainder of the answer. The gentlelady's time has expired. The gentleman from Massachusetts, Mr. Lynch, is now recognized.
Thank you, Mr. Chairman. Madam Secretary, would you like additional time to express your thoughts there? You were sort of cut off. Rather than adding them in writing, would you like some time to respond?
Yes, if I could just.
Or we could move on, whatever your choice.
Thank you. If I could finish the thought.
Yeah, that'd be great. Yeah.
Sometimes activity-based regulation is the appropriate approach when there is an industry-wide practice of concern, as, for example, has been the situation with money market funds or with open-end bond funds. However, sometimes the risks have to do with a particular institution. For example, the largest U.S. banking organizations are recognized that their failure could result in a threat to financial stability. The same could be true of a non-bank institution, and in that case, designation is appropriate, but it depends what's the appropriate form of response by FSOC depends entirely on the specifics of a situation and the threat that's involved.
And I thank the gentleman for his time. I couldn't.
Reclaiming my time, reclaiming my time. Well, that makes perfect sense, Madam Secretary. Recently, FSOC identified the use of artificial intelligence in financial services as an emerging vulnerability in the U.S. financial system. And not very long after that, Chairman McHenry and Ranking Members Waters created a bipartisan working group on artificial intelligence. And I have the good fortune of being the top Democrat on that working group. I have some concerns. I think there are some opportunities, I think, to use artificial intelligence in a thoughtful way. I think about the work that FinCEN does and trying to analyze suspicious activity reports, suspicious transaction reports, and CTRs, and how they might analyze those. But I think there's also a risk on the explainability end of some of these algorithms that are being used, and also the fact that many smaller firms are acquiring rather than developing their own data sets and developing their own artificial intelligence. They're just simply buying them. And I'm not quite sure that that they have the expertise or the personnel to make sure that technology is used in a compliant way with existing financial regulation and laws. Do you have a sense of whether we have the capacity in the industry to onboard much of this artificial intelligence that is being, that vendors are offering to financial firms?
Well, we are concerned in this year, FSOC identified the use of AI in the financial sector as a potential financial stability risk. And at the moment, we're trying to understand what the risks are. Some of them are related to, as you said, explainability when models are used and generate outputs. I believe the CFPB has been clear that financial institutions, when they take credit actions, have to explain to the customer what the reason is, and not to be able to say, well, an AI system generated this result. But there are a whole variety of risks to customers, to cyber, and we're trying to build our expertise and work with the financial sector to address these risks.
Is it accepted that, at least from Treasury's position, do we accept the fact that when a financial firm acquires AI, that AI company, that vendor is now a covered entity under, financial services laws? Is that accepted, or is that still in dispute?
I'm not sure. I need to get back to you on that.
Okay.
But certainly when it comes to third-party providers, the banking regulators, for example, do have authority to make sure that
The gentleman's time has expired.
standards are being
The
met.
gentleman's time has expired.
Thank you, Madam Secretary.
I now recognize myself for 5 minutes. And Madam Secretary, you tout a historic recovery, a healthy labor market, and quote, economic strength. And Larry Kudlow's name was invoked earlier in this hearing, the former Trump White House economic advisor. I know Larry Kudlow, and yes, he acknowledged that we're not in a recession right now. And I wouldn't presume to speak for Larry Kudlow, but I do think he would agree with me that asking Americans to feel good about Bidenomics is like asking them to smile during a root canal. The discomfort is just too hard to ignore. Americans continue to suffer from the effects of 40-year high inflation experienced throughout the Biden term so far, including lingering high prices. And the administration may wish to tout inflation numbers coming down. But Madam Secretary, you're an economist, and as you know, inflation, which is the rate of increase in prices, should not be confused with the overall level of prices. And prices have continued to rise even as the rate of inflation has fallen since the Fed began an aggressive program of monetary tightening and since House Republicans put a stop to Washington's spending spree. So as a result today, even with the decline in the rate of price increases, a family of four is paying $15,000 more per year just to purchase the same goods and services compared to the day President Biden took office. Yet the administration's plan to fix inflation caused by too much spending is even more spending. That's why the Inflation Reduction Act is perhaps the most misnamed legislation in American history. But this is a supply-demand mismatch. Too much spending created excess demand. Climate obsession constrained the supply of energy. But now the administration and the Fed is proposing to constrain the supply of credit, which will exacerbate inflation through this Basel III endgame, precisely when corporate and commercial real estate borrowers will need to refinance at higher rates. So, Secretary Yellen, I want to ask you about Basel III. The heterogeneity and business model diversity within the banking sector distributes and diffuses risk across the system, and I believe contributes to system-wide financial stability. The Basel III endgame proposal would de facto repeal regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently apply to GSIBs, eliminate the use of internal risk models, and transition the industry and regulators toward a standardized framework, reducing business model diversity, and push financial intermediation and lending outside of the bank regulatory perimeter. The banking industry will get smaller and more concentrated as a result. How does any of this reduce systemic risk?
Well, having strong capital and liquidity and resolution standards, I believe, does diminish systemic risk. And I think we have seen a clear example of this in the ability of the banking system to weather the pandemic.
Yes, ma'am. And reclaiming my
But
time, just
there-
real quick, reclaiming my time, you have said many times that our banking system is currently well capitalized. Do you agree that a less diverse banking system, a barbell banking system, banks under 100 billion not directly affected by this proposal, and Wall Street too big to fail banks, but no regional banks because of the forced consolidation this would provide, and less diverse business models that this proposal will produce, do you believe that that strengthens financial stability or undermines stability?
I think we benefit from having a diverse banking system with institutions that meet different needs of different firms and
I agree.
different households.
And
The
Secretary,
banking agencies have received extensive comment
yes,
on all of these issues.
I know. And just
And-
reclaiming my time because I only have a minute left. I agree with you that diversity and heterogeneity in the banking system and diverse business models actually diffuses risk. And FSOC should consider that as they consider Basel III Endgame. So to my final question, continuing with this topic of consolidation, which I believe Basel III would accelerate, the OCC's recent proposal on mergers and acquisitions would ban mergers for a nationally chartered bank, even if it's a transaction for a smaller CDFI or adding essential technology expertise. Even the smallest banks would face new scrutiny and prolonged delays of mergers that could threaten their viability. The OCC's proposal will increase the likelihood of costly and disorderly bank failures and decrease competition for GSIBs. Secretary Yellen, won't this proposal increase systemic risk and reduce banking services?
I'm sorry, I think this is a question for the acting controller of the currency rather than.
Well, my time has expired, but I think it's an FSOC issue, is the fact that you would not have orderly consolidation and results in bank failures. That is a systemic risk issue for you, Madam Secretary. With that, my time has expired, and the gentleman from California, Mr. Vargas, is now recognized.
Thank you very much, Mr. Chairman. Thank you very much, Madam Secretary, for being here. Appreciate it very much. Going to try a couple questions here. First question, trivia question. When was the last Republican president that ran a budget surplus?
I can't think of one, but
Think hard. Because I don't remember, but every time I'd hear,
I certainly remember that Bill Clinton did.
oh, Bill, was he a Republican?
I don't believe so.
I don't believe so either. Yeah, it's interesting. Every time you get up here, you hear these guys on the other side start touting, their fiscal responsibility, and yet every time they have a president, they either jack up the deficit, ruin the surplus, or destroy the economy. And then we come in and we fix it, and then they're upset. Once again, they become fiscal hawks. Now, I do have something I have to get off my chest about you, and that is, I think you're probably the smartest person that comes and testifies before us, and I think most people would agree with that. And yet, every time you used to come and they used to beat you up on inflation, you never put it in the context of what was happening in Europe and the rest of the world. You would simply try to explain inflation within our own country, and it used to drive me nuts because we were doing better than the rest of the world.
We are.
We are, and you
doing
never said that. And I was too far down the totem pole here to ever be able to get to ask you that question.
Well, if you look at the United States vis-a-vis other advanced countries, we have by far the strongest growth. Inflation has fallen more in the United States than in any of these other advanced countries, with the exception of Japan that has a different set of issues. And importantly, real wages, inflation adjusted wages. I believe we're the only country that since the pandemic has seen those increase. And I think according to our calculations, if you compare today with 2019 before the pandemic, that The typical American household has enjoyed wage increases large enough that the median worker is able to buy the same basket of goods as in 2019 with $1,400 left over to spend or save. So we've gotten ahead in the United States. It's been an equitable recovery, includes and even the strongest gains for low-income
So
people.
I agree with all that, and I wish you would have said it before, because it always used to annoy the hell out of me, because you would lead with your chin. I think you're the smartest person here, and maybe the good thing is that you're not political, and that's why I think you'd lead right into their questions, which was political questions. They were really sophist, if you study the Bible. They were really asking you questions to try to do a gotcha. And it always used to annoy the hell out of me, and you never explained it this way. I'm glad you did today. I do want to talk about climate. That's the issue that has also driven me mad these last 2 decades. I've been preaching this for a long time, saying we have to do something about it. I did work in the insurance industry for a while, and whenever you had a big event, we called it a CAT, or catastrophe. And you numbered them by a year catastrophe, a 5-year, 15-year, 20, 25-year, 50-year, 100-year. We just had what they would call a 1,000-year event in San Diego. And now we're having what we call a 100-year event again in San Diego. They're no longer, cats of 100 years. They're happening all the time, and it's the weather. This is a real risk.
Absolutely. It's clear that's exactly what we're seeing. And vulnerable parts of the country, whether it's California or Florida, in some cases in New York, Louisiana, we're getting priced out of insurance. Either the rates are becoming unaffordable, or insurance companies don't want to bear the risk, can't reinsure adequately, and are pulling out. And this
There's a
can cause
line in
tremendous
insurance, Madam
problems.
Secretary, that you should know. There's never a bad risk, only a bad price. And when they take a look at this and they see what it's going to cost them, these actuaries, they're soulless people. They sit in this room and they find out what it's going to cost them, and they're not in the business of losing money. And they look at Florida, they look at these places, say, we're not going to lose money. That's why they don't want to insure there.
Absolutely.
They're soulless people. I'm not saying they're bad people, just don't have a soul.
They don't want to
Again,
lose their
my time
shirts.
is up. I thank you very much.
All right. There's bipartisan laughter at actuary humor. We'll now go to the chair of the Small Business Committee, Mr. Williams of Texas.
Thank you very much. Well, I'm a car dealer, not an insurance guy, so let me put that out there. The crisis at our southern border has spiraled out of control, and the Biden administration has done little to nothing to secure the border and keep Americans safe. This increase in illegal immigration raises concerns on how the increase in migrants coming down across the border is impacting our financial network and opening the door to financial crimes. Money laundering, drug and human trafficking, and financial fraud will continue to plague our communities if nothing is done. I recently introduced the Evaluating the Financial Impacts of Illegal Immigration Act, which requires FSOC to include illegal immigration risk, an emerging threat to our financial system, in their annual report and provide recommendations to mitigate these risks. Our states and cities are not equipped to deal with the influx of millions of migrants who put a significant strain on our public resources. We must hold government agencies accountable to report on how illegal immigration impacts Main Street and the larger financial system. So Secretary Yellen, this will be easy, just yes or no. Do you agree that illegal immigration is a potential threat to our financial system? Yes or no?
Well, I can't answer it just yes or no. You've pointed out some risks that are associated with immigration, and whether or not that's a threat to our financial stability is a complicated determination.
So you would say yes?
I would not say yes.
You'd say no?
I say it requires further
All right.
analysis.
So as I previously mentioned, we've seen the strain that illegal immigration has and will continue to have on our public resources. Therefore, I think it's necessary to see how far these impacts reach. And I request that you use the power as the chair of the Financial Stability Oversight Council to investigate this emerging risk. Okay? So over the last year, our nation's federal banking agencies have been bombarding our financial system with excessive regulations and dangerous proposals like Basel III Endgame, which will dramatically affect the banking community and have other broad impacts on Americans' ability to access reliable credit. Now, these increases in costs will make it harder for Americans to obtain a loan, whether they want to start their own business, expand current business operations, or buy their own home. Small businesses and everyday Americans rely heavily on loans and credit lines from banks of all sizes to access the capital they need to do so. Multiple regulators, including Chairman Powell, have come before this committee and testified that our banking system is already well capitalized and resilient, and FSOC's 2023 annual report stated that banks continue to have sound levels of regulatory capital. So, Madam Secretary, if FSOC and federal banking regulators have repeatedly identified the U.S. banking system as capitalized and resilient, then what is the need for the proposed massive increases in regulatory capital called for in Basel III Endgame proposal? And also, how can we ensure proposals are good public policy when they lack a rigorous cost and benefit analysis?
Well, I believe that the banking agencies, in putting out their rule, have pretty clearly articulated what their concerns are with the way in which operations risk and market risk are handled, and some of the ways in which internal models are used to evaluate credit risk. And I know they've received many comments and will take those seriously in coming up with a revised final rule proposal.
In the time that I have remaining, in 2023, FSOC listed climate change as vulnerability to our financial system. Under the Biden administration, financial regulators are calling for climate policies to be included in banking regulations, which extends the federal banking system beyond its intended purpose and threatens the agency's long-term independence. Now, this sets a dangerous precedent that could lead to overall polarization of our financial system. So quickly, Secretary Yellen, is FSOC exploring nature-related financial risk, and will they urge federal banking agencies to issue guidance to financial institutions on how to manage purported nature-related financial risks?
The banking agencies are evaluating what the impact of climate change is on the institutions they regulate and working with them to make sure that they are adequately evaluating the risks that climate change pose. And those are important supervisory activities that bear on safety and soundness.
Okay. Mr. Chair, I yield my time.
Gentleman yields back. Gentleman from Illinois, Mr. Foster, the ranking member of the Financial Institutions Subcommittee, is recognized for 5 minutes.
Secretary Yellen, as I discussed in my opening remarks, I am happy to see FSOC identify artificial intelligence as an area of concern for the financial system. While there are clearly benefits of certain applications of AI in areas like customer service, credit underwriting, and certain forms of fraud detection, I am worried that we are heading for a disaster when it comes to generative AI and deepfakes. Just last week, a finance worker at a multinational firm was tricked into paying $25 million to scammers following a multi-person video conference call with whom they thought were their colleagues, but were in fact deepfake AI impersonations. Not only did the scammers simulate the voice and likeness of the chief financial officer, they simulated several of the employees' colleagues at the same time. Now, I believe that the clearest and cleanest solution to this issue would be to have a simple but reliable form of digital ID, built off in the United States, built off of TSA's Real ID system, and based on NIST technical standards that are already built into all modern cell phones. Then that US citizens could then use this to prove they are who they say they are online and verify one's identity remotely. Several states are rolling out these mobile IDs for things like keeping children off porn websites. And several European and Asian nations have already taken steps to offer their citizens this form of digital ID backed up by a secure device and biometrics. The EU is moving rapidly towards a standard, and they are using it from the start to be useful to verifying financial transactions. So first question, are you aware of the steps that other nations are taking not only to offer digital ID, but to make it usable for verifying financial transactions? And do you believe it would be a useful component in preventing deepfake AI impersonations here in the United States?
I think you're making a very valuable suggestion. I know that FSOC is in Treasury, you're engaging on this issue with financial institutions. Our staff are planning to issue a report on AI-specific cybersecurity and fraud risks. I believe they plan to issue that by the end of March. I've not seen the work myself that they're doing on this report or what recommendations they'll come up with. I know they will be doing follow-up work with the financial sector, and I think you've made a very
Yeah, well,
valuable
many financial
suggestion.
firms I talked to just told me that a reliable form of digital ID would really simplify all of the AML KYC process, make it faster, cheaper, more reliable when they had to confirm the identity of customers. And so you also mentioned the difficulty with having this spread out in many agencies. For example, the TSA and the DHS committee and Congress sort of are in charge of the mobile ID, the real ID system. On the other hand, it's FinCEN and Treasury that would supervise its use for financial transactions. The actual technical standards are done by NIST, which is the oversight of the Science Committee. So we have at least 3 congressional committees that are all siloing this whole thing. And so is there encouragement that you need to get FinCEN and TSA and NIST to all work together to deliver a product that can eliminate deepfake impersonations in financial transactions, at least?
My suggestion would be that my staff contact you and work with you on the specifics of this and give you some specific information on exactly what our thinking is on this. I'm not
And if you find
knowledgeable
any
enough to.
specific encouragement from Congress, I think there will be bipartisan support for that on all
Of course,
three
this is
committees.
a significant risk, and it's.
Okay, now in my 42 seconds here, last January, I introduced the Strengthening Cybersecurity for the Financial Sector Act that would give the NCUA and Federal Housing Finance Authority the authority to oversee third-party vendors that are employed by the entities under their purview. Other prudential regulators already have this authority. However, NCUA and FOFA's authority were allowed to expire, and this left a dangerous gap that leaves consumers and our system at financial risk. In fact, last November, a cybersecurity breach of third-party service providers disrupted the operations of 60 credit unions across 40 states. Can you explain why this authority is important and the kind of risk that this lack of authority presents the financial system?
Well, it's critical to oversee these providers, and FSOC has recommended that NCUA and FHFA be given these authorities. We appreciate your legislation and would be glad to work with you on it.
We'll now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Mr. Chairman. Ms. Secretary, thank you for being with us. Good to see you again. I want to start off by asking you about the non-voting state insurance commissioner seat on FSOC. While I support the long-standing idea of state-based insurance regulation, I recognize that the insurance industry is critical to the overall stability of our financial system. Nearly every aspect of our financial system is represented by its primary regulator on FSOC with a voting seat. But without a voting seat for state insurance commissioners, the council is missing the direct input from the primary regulator. My question is, do you agree that we should have state insurance regulators with a voting seat? And if not, why?
Well, I absolutely agree with you that the insurance sector is critical and needs to be represented. I would note that there is a voting member of the council who is an independent member with insurance expertise. That person is confirmed to that position. And in addition, there is a state insurance commissioner, a non-voting member, but someone who serves a 2-year term designated by NAIC. So there is a good deal of understanding of the insurance industry represented on FSOC, and I think that's totally appropriate.
Do you not feel that it would be better representing of the primary regulators of the insurance industry if the non-voting member from the State Insurance Commission was actually a voting member?
So I don't have a position on this. Congress set up FSOC in this manner. And what I can tell you is that all of the members voting and non-voting contribute importantly to the work of FSOC. I've really never seen an issue that I've dealt with where the voting status of a person who's part of FSOC would have made a critical difference.
So it'd be fair to say that if Congress did seek to change this, you would not oppose?
Well, I would look at the specifics, but I would agree with that we do need to have insurance expertise, and happy to look at something specific that you're considering.
Okay, well, thank you. Earlier, you were asked about the Federal Insurance Office, FIO, plan to collect 6 years' worth of granular data on climate-related financial risk. FIO expects hundreds of property and casualty insurers across the country to assume the burden of compiling this data. You asserted that FIO looks to work with state insurance regulators as required in the Dodd-Frank Act, but FIO claims that the data they had initially requested was, quote, not available or could not be obtained in a timely manner from state regulators. Secretary Yellen, how did FIO define the timely manner for the purposes of collecting this data?
Well, my understanding is that the NAIC intends to conduct its own survey and recognizes the desirability of collecting this more granular data. And given that FIO and NAIC want to collect this data, there clearly exist opportunities to collaborate. I believe they're certainly trying to do that.
Well, I guess I'm a little bit confused is they defined that they needed the data within 30 days of the request. Now you're talking a significant amount of data, but they were obscure as to what they needed the data for. And so why did FIO anticipate needing this data within 30 days? So you're talking, asking these insurance questions that are very detailed and giving folks 30 days to respond. And it was kind of obscure in the question. I'm just wondering why such a short time frame?
Okay, I must admit, I don't understand if that's the time frame or what the logic was, and maybe I can get back to you on that.
Just with just the remaining time I've got, in your view, was FIO's limited not just ask them, can you get this data? And they say, we really don't have time, and then say we couldn't get it. I mean, to me, it seems like working with them is coming up with a reasonable plan to get the information they need and be clear as to why.
I believe they intend to do so, and it's appropriate.
Thank you. I yield
Gentleman
back.
from New Jersey, Mr. Godheimer is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Waters. Hello, Secretary. Thank you for being here. Secretary Yellen, are you aware that from 2014 to 2019, 200 American colleges and universities illegally withheld and failed to report information on 13 billion in undisclosed contributions from foreign and authoritarian regimes?
I don't believe I am. I'm sorry. What happened? The college, something about colleges?
Colleges received and didn't report funding from foreign and authoritarian regimes. I've sent you a letter, which I'll make sure you get a copy of, urging Treasury to coordinate with the Department of Justice and Department of Education to investigate these American colleges and determine whether any of the foreign and authoritarian regimes contributed to the funding of anti-Semitic protest groups on our college and university campuses. And so I'll also enter the letter into the record, if that's okay, Mr. Chairman.
Without objection.
And again, thank you for reading it. And if you can get back and determine whether there are financial connections between those foreign entities making large donations to our institutions of higher learning and the outside funding of anti-Semitic protests on campuses, I'd be grateful.
We'll respond to your letter, try to do it in a timely way.
Thank you. Madam Secretary, the last time you were in front of this committee in June, you agreed with me that the state and local tax deduction, or SALT, has had a disparate impact on different states, including New Jersey, where I'm from. You've also committed to finding a fair solution for the misguided limit that leaves double taxation on many of my constituents especially middle-class, hardworking families. There may be a potential vote on SALT legislation as early as next week. The bill would double the SALT deduction for married couples in 2023 from $10,000 to $20,000. Do you believe, following the question when I saw you last time, do you believe that this legislation will help ease the disparate impact of SALT on married couples in New Jersey?
You know, I agree that SALT has had a disproportionate impact on different states. There are also fiscal limitations from the legislation that you discuss. I haven't had a chance to examine, and it's really up to the White House and the president to decide whether or not to be supportive of this.
My concern from a Treasury perspective is the IRS preparing for such a change should the bill be enacted, because they would have to move pretty quickly.
This would be for 2023?
Yes.
I'd have
Okay.
to
If
look
you can get
into
back to me
that.
on that, I'd be grateful. We know that Hamas relies on support from the Iranian regime, the leading state sponsor of terror. As Iran deepens its ties to China and Russia, we are reminded they cannot be trusted and must be held accountable. Iran has directly or through their terrorist proxies, including Hamas, Hezbollah, PIJ, killed hundreds of Americans, attacked our bases and our allies in the region. Treasury has implemented several rounds of sanctions on Hamas and Iran in the aftermath of October 7th. Madam Secretary, do you believe that the U.S. should impose sanctions on China because of its ties to Iran?
I'm sorry, on China because of its ties to Iran?
Yes.
Well, that's a question really for the State Department and the interagency, and I'm not aware that that's been considered. I don't have a position to offer you on that.
Okay, because concern that Treasury hasn't enforced Iran oil sanctions, especially sanctions targeting China and its dozens of teapot refineries that are responsible for practically 100% of Chinese oil imports from Iran.
Look, what I can tell you is that the Treasury Department and OFAC are doing everything that they possibly can to crack down on illegal Iranian shipments of oil. And we've recently had actions in that regard and believe seizures of illicit material as well.
Thank you. I know Treasury's OFAC publishes a list of individuals and companies owned, controlled by, or acting on behalf of individual groups and entities such as terrorists. Their assets are blocked, and U.S. persons are generally prohibited from dealing with them. In recent weeks, it's been reported widely that UNRWA employees have engaged in terror activities and materially supported Hamas in the massacre and in other depraved atrocities committed against Israel. Is Treasury considering terrorism designations for UNRWA employees that have been found to be material supporting Hamas or engaging in terror activities themselves?
We've engaged, as you mentioned, in numerous actions against Hamas and a wide range of supporters.
While the U.S. gives millions of dollars to UNRWA every year, the organization doesn't screen for known terrorists and terror affiliations the way U.S. agencies like USA would do. Do you believe that a minimum, the UN agencies that receive U.S. aid should at least vet employees against U.S. terrorism lists?
I don't know. I don't know the details. I'm happy to look into that. That's certainly seems reasonable.
Thank you, Madam Secretary. I'll follow up with your office. Thank you so much.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Chairman. Madam Secretary, thank you for being here today. And I just want to highlight a couple of the activities of FSOC. For the last 2 years, FSOC has made digital assets one of its top priorities. Do you believe that it is appropriate for FSOC to list digital assets among its top priorities, given the relative size of the market?
Well, the market is relatively small, and I believe the annual report states that. And the connections are not enormous to the banking system, although role involvement in digital assets did play some role in the banking problems we had last March, particularly with respect to Signature Bank and to Silvergate. So there are concerns along those lines.
Well,
but
in that
there
sense,
is the potential for example, stable coins that we have we've made recommendations to Congress, require regulation.
Gentlemen will
They could,
suspend.
they
If
could
the secretary
scale-
will suspend, if you could please exit the dais for members. Thank you. We can continue. Thank you.
Sorry. Stable coin, there is no appropriate regulatory framework.
We've
and it's
we've certainly
something
been
that could
working on
become,
that. It'd be great to get it across the finish line.
To see legislation enacted.
And so the concern would be that there's some systemic risk to the market because of the introduction of digital assets. And you referenced Silvergate. They didn't pose a systemic risk to the market. In fact, they wound down in a very orderly fashion with no risk to the market. Not true of Silicon Valley Bank, but that was interest rate risk, not digital assets. Signature, on the other hand, there was an FSOC meeting on Saturday, and on Sunday, the assets of Signature Bank were seized. And former Congressman Barney Frank, whose portrait hangs right there, former chairman of this committee, said that it was because they were banking crypto, not because they were insolvent. So it kind of highlights, is there a coordinated effort because there's a disfavored industry like digital assets, or is there a coordinated effort because there is actually systemic risk?
Well, FSOC has recommended to Congress that stable coins require a regulatory framework. No stable coin at this point may yet have achieved the scale that would pose a systemic risk, but certainly that could happen if a stable coin were widely used for payments. And you have the classic run risk that's associated with that if the stable coin proceeds are not invested